Good morning, Friday, August 10th, 2018. Kirk Spano, margin of safety, fundamental trends, Blue Mound asset management, and other websites yet to be developed. So, today we're going to talk about Turkey, China, Tesla, and oil, and then do some questions at the end. And so let's start right off with Turkey, which is getting crushed. The lira's at an all-time low. Erdogan doesn't have any idea how to handle his economy. And like Xi, who you can also see on the screen there, is a hard ass, a stubborn dude. So we have to wonder, is Turkey going to cause problems with the European banks? The reason that could happen is that the European banks have a lot of money invested in Turkey, which was a growth machine for several years, but it was almost entirely debt-fueled. So in the case of any debt-fueled expansion, you generally have to ask the question, and look, Elon Musk making an appearance. You have to ask the question, what happens when the easy money is no longer available? So the answer usually is things get bad. And that is one of the reasons why we at Fundamental Trends and at Margin of Safety Investing, I'd say, 2 weeks ago? Started to do some hedging. This is a list of some of the options that we do every month. But we started to do some hedging. The one that I'm in mostly is the S&P 500 Hedge, which as of today we're about even on. I'm actually at 285 because I held off a little bit. And prior to this, we were short Italy. And I know that several people are still short Italy. I'm not. As a good Italian Catholic boy, I just didn't have the heart. But actually, I thought they were going to get a bit of a rebound. And then this Turkey thing, I think, came on a little faster than people thought. So now we're starting to see quite a few of the stresses that are in Europe that Ray Dalio had positioned for. Remember Ray Dalio, early this year, it was disclosed that he had a lot of shorts on Europe, and everybody else was being very positive. At the same time, we were talking about being short Europe, ahead of finding out Dalio was also doing it. So got a little bit of validation there. We ended up making quite a bit of money on the Italian shorts. I don't know exactly how many people took part. I know at least a dozen or two, and those ended up being pretty good hedges. So where are we hedging now? Like I said, I'm pretty much hedged in the U.S. and the S&P 500 seems to be the place where I want to be hedged. Haven't quite gotten these puts executed, and the Healthcare Select Spider put, I have not looked at it in a couple of days. I had an order outstanding, so the 85s. Let's see here. Yeah, so right here, I'll tell you, the last 3 months, healthcare is just drifting up. I think that this is going to be one of our best shorts. I wonder about that little turnover there. Take a look at the Chaikin money flow. Starting to turn over. That is a negative divergence. Money flow starts to head down, but the stock is still going up on momentum. I tell you what, I think that you might want to be looking at these Healthcare Select Spiders, the puts, right? We may want to buy these puts, maybe today, maybe tomorrow on a bit of a rebound. We'll see. But I think this is going to be one of the greatest puts that we ever own. Why? I think the entire healthcare sector is headed for a massive bear market. And I think it could be triggered by any number of things, including pressure from Congress, or at least rhetoric from Congress, and even President Trump. But if markets just start to turn over because of emerging markets risks, because of the dollar getting stronger, because of oil getting more expensive, which we'll get to, um, you can see healthcare tumble right along with it. And the thing is, in the last 3 quarters, healthcare has been rallying because people look at it as a safer place to invest. It's not. And I can prove it. Where is 2009? Oh, let's go a little bit further. 2100, or let's see here, 35, ultimate low, 20, 25, right? 2197 from 35. So that's 40%. So healthcare had a 40% drop during the financial crisis. I think that you're going to see at least a 40% drop. I actually think that this entire rally coincided with Obamacare. Here's Obamacare. Why that rally? Right? All these years. Chop, 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 a little bit of drift. Big correction. Obamacare. Bam! So why did the healthcare companies, I know we weren't going to talk about healthcare a lot, but I just think this is a great short. I think anything can trigger this to come back all the way back into this range. Right in here. So it's 89 right now, and I'm saying it could go down to in the 40s. So when you take a look at the holdings, you go right through all these, with the exception of Johnson & Johnson. United Healthcare, I've said it can drop 50%. All of the pharmaceuticals can drop 50%. The benefit managers can drop 50%. The health insurance companies, 50%. There's a lot that can drop 50%. And even Johnson & Johnson is not immune from big drops, although I think they are the highest quality company, right? So here's a recent drop from 147, got all the way down to 120. But when you look at their history, pretty damn good stock, right? So where does it belong? I don't know. You take a look, they have really no no reason to have a PE ratio quite as high as they do, right? If you have revenue growth of about 10%, let's say their earnings growth is 10% too. It's not. It's been 4%, 3.5%. But let's say their earnings were growing 10%. Okay? So you want to take price to earnings to growth. Growth ratio of 10%, and you want a PEG ratio of around 1.5. You're not getting that with these guys, right? So even if their earnings keep growing at 4% per year, which is not particularly fast, right? It's just drifting higher. You really wouldn't expect a premium valuation. The reason people give it a premium valuation is because they think it's so safe. Well, so let me ask you. When you go to the grocery store or you go to the pharmacy, how many things do you see right next to the Johnson & Johnson's products that are exactly the same and for 30% less in price? Quite a few, right? Do you really need Band-Aids? There's identical stuff right next door for 30% off. So the reason they don't have much of a growth rate is because they're having a hard time continuing to sell all these high margin products. So they're never ever going to have a boost in growth. Never ever going to happen. So even Johnson and Johnson, can drop quite a bit. Price to book value over 5 should be down around 2, maybe 3, maybe 4. That price to earnings ratio is trailing. So if you want to take a look at forward price to earnings ratios, PEG is in here somewhere. PEG they don't have listed. I guess I was wrong. But price to book value, that's the easy one to look at, right? We definitely, all these ratios are high. So do you believe that the stock, which used to have a higher growth rate, still deserves a 29 PE, which is what's been its average PE over the last 10 years? The answer should be no, because growth isn't as high going forward as it was in the last 10 years. So you'd expect their PE to be less than 29. It's not right now, it's way higher. So even these guys could drop quite a bit. How much? 50%? I don't know that that's out of the question. Around 100-ish? Could it go much lower than that? 90-ish? Could definitely do that. So when we take a look at the healthcare sector, even the highest quality names are at risk. So you have to be careful. I know that everybody wants to say, well, but this is what they did for me before, and this is who they are, and blah, 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 blah. Look, if there's no growth rate with a company, then they better not have a growth-oriented price-to-earnings ratio, right? A PE of 30 or 40 or 50 is for a stock that's growing almost that fast. Johnson & Johnson is growing a single-digit amount, like a bank, right? So they should not have a PE that's in the stratosphere. Bottom line, eventually valuations matter. They do. They always have. They started to matter in 2000. They started to matter again in 2008. And now we're 10 years into a bull market with rising interest rates. So that means that we're in the end game. Doesn't mean that it has to trip over right away. Usually at the front end of rising interest rates, the market continues to go up. So we still probably have a little bit of upside. That's why I said, as this market gets towards 3,000, become a net seller. And then that's what we've become. Now, this autumn, there are some events that make you think, well, we could have a correction, then a rebound, and then another correction. And that's kind of what I expect. I expect the sanctions on Iran. I expect the midterm elections. I expect what's going on with Turkey. I expect the trade issues with NAFTA and with China and with Europe. All these things are coming to a head between September and November. It's going to be a volatile period. I have not made a volatility trade yet because it hasn't been easy, and I don't like hard trades. So at some point we will get an easy trade on volatility, you would hope. We don't know that, but this is a trade that we made a ton of money on in February. Well, let's just go year to date, right? So we were buying calls on VIX in here, right? And people go ahead and post, who did this, who took part in this. But we bought calls in here, got the spike, and now it's come all the way back down. So if we take a look, VIX isn't quite as low as it should be. I think the symbol is VIX. I want an index. There we go. When this gets to single digits, right, because this is just the index, it's not impacted by the same forces that bring the ETFs down. So we got all the way down to 9.15 on the actual volatility index. The other day we were down to 10.85. Will we get under 10 again? I don't know. I suspect maybe we will. If we get under 10, we're going to want to start loading up on those calls again because it doesn't go lower. Just doesn't happen. Okay, you see it doesn't happen. Got it? Doesn't happen. So if we actually get a single digit VIX, you buy the calls, you hold your nose, because you're usually going to get a spike. All right, so that is another hedge that we don't have in here yet because it wasn't ready to be done. But most of these other trades are ready. If you want to hedge your portfolio by putting 2, 3, 4% of your money into some of these hedges, that's probably a good idea. Now, if you don't believe me that we're headed for a healthcare bear market, fine, don't buy it. Well, what about consumer discretionary spending? Well, what numbers did we just see today? We just saw that inflation beat the headline number and really offset the increase in wages. So what if, as we learned on Friday, I believe, what if hiring really peters out? And what if unemployment starts to rise? What if these tariffs have a negative impact on employment? We know that Harley Davidson is moving jobs overseas. We know that there's a company in South Carolina that just had to shut a plant. These trade tensions don't come with winners. And that is just something that the government's going to have to accept at some point. I think a lot of people understand that you have to do these things at the margins, that a trade war generally is a lose-lose situation. And in this case, China has the upper hand. Why does China have the upper hand? Because the president of China is the president pretty much for as long as he wants to be, right? So there's a political equation here that in the United States, although we've gotten tougher on protesters, which is, in my opinion, very un-American, we don't run them over with tanks either. So in China, if there's a recession, it's not really going to cause much upheaval. There will be dissidents, but they'll get thrown in prison, and the odds of the government getting overthrown are, slim and none. The odds of people getting elected out are slim and none. So in the United States, what you're seeing right now is the front end of probably a pretty significant political change. You're probably going to see Democrats take the House of Representatives in November. It really looks like it's going to be close in the Senate. I mean, it could be a 50-50, 51-49, 49-51, either direction. It's hard to know. But in China, it doesn't work that way. There's not going to be a change in the ruling party, right? It's going to be the Communist Party. They're a one-party system. Think about that. So if they want to jam it to us in order to influence our elections, they don't have to hack us. They don't have to put fake news on Facebook. They can just take a step back from the global economy, blame it on Trump's trade war, and say, okay, have your recession, enjoy it. And if that occurs, then we're going to see unemployment rise. And that's going to cause consumer discretionary spending to drop. And therefore, while I don't know that this will happen, it is a high value proposition because if it falls off a cliff, 4% of your portfolio becomes 16% of your portfolio or 20% of your portfolio. These are options that can go up 2, 3, 400% if there really is an economic shock. And right now we're lined up for a lot of economic shocks, not only because of Turkey, but because of China. So I don't know if everybody's subscribing to Bloomberg. I will tell you, if you're not subscribing to either Bloomberg or the Wall Street Journal or both, or the Financial Times, I subscribe to all three, you're really just missing out on some great stuff. I think that Bloomberg is the one to get. because it is the best with charts to help you understand. So I'm going to tell you, you really should get the all access pass at Bloomberg. You get it for $9.99 for I think 3 months. Then it goes up to $39.99. Is that expensive? Sure, I guess it is. But if you're an investor, if you can't afford $39.99 for Bloomberg, why the hell are you investing? So get Bloomberg, probably get the Wall Street Journal, at least get the weekend edition with the online. That'll probably get you. Financial Times is more expensive. If you're going to do international investing, you have to have it. So just throwing that out there. And finally, I actually have told you guys about Value Walk Premium. Oops. Go to Value Walk Premium. I did something special for everybody. Am I logged in? Oh, stop that. I am logged in. Howdy, Kirk Spano. Kirk Spano got you all a discount for Value Walk Premium. So if you want, I'm going to put this in the chat. If you want to get $15 off on an annual subscription, and I get nothing for this, although I might ask him for something. Where can we subscribe? I'm already a subscriber, so I have to log out. Oops. But Value Walk Premium, well, it keeps logging me back in. Anyway, it's like, oh, there you go. It's $90 a year. So if you use the code Kirk15 off, you get it for $75. This has the letters from a whole bunch of the hedge funds and a lot of special contributor stuff. And I'm actually going to become a special contributor here. I've just been totally impressed with what this kid, Jacob, is doing here. He's been doing it for a number of years. He's got a small team out in New Jersey. I might stop and see him on my trip out east. So I'll talk about that in a minute. But all these hedge fund letters, the research you get is just unbelievable. Am I logged in or am I logged out? Oh, okay. In any case, Value Walk Premium, Kirk 15 off if you want it. Let's back to our regular scheduled program. I'm looking at Chinese investments, and I want to compare all the Chinese ETFs. So right now we see that all these ETFs are turning over, but they're not as quite as low as maybe you want them, right? They could go a little bit lower. So I know people are getting excited about buying the Chinese ETFs and buying Chinese stocks, but look, they're still not back down to their 2 and 5 year lows. So we have to really think about how low do we need to go, and ultimately which ETFs we want to own. So we can buy the stocks individually. I think that's tough. I think it's tough for us to own Chinese stocks because finding information on individual companies is really difficult. So you take, and for us to understand it, right? So we take a look at the ETFs. This is FXI, the iShares China Large Cap. Then we have the iShares MSCI. And this one's kind of important because these guys are controlling some of the international indexes. And MSCI is really a leader in that. So Tencent, which is on my list. Alibaba, which is not because I don't like the structure of the company. China Construction, Baidu. We were just talking about JD on the chat room this week. NetEase. I actually like China Mobile. So the MSCI and the Spider. are pretty similar. So you take a look, similar holdings, but I think I'd probably, oh, this one. There you go. Tencent, Alibaba, China Construction, Baidu, very similar. So the Spider and the iShares MSCI are really close. Now, the Spider, which is typical of their American funds as well, they like banks. So one thing to remember about China, and I had popped it up here somewhere. So China, it's got some banking problems. I was playing with that. There we go. So China's got some banking problems. All right. And we have to be careful of this is something else. Guess I didn't put a lot of China up here. But China's got some banking problems. There's a financial instrument there called a NDC, and that's basically like a CD and like a bond kind of mixed. It's a debt. It is a debt holding that the banks issue, and a lot of these are backed pretty weakly. So a lot of the banks could get in trouble in China, and they'll do what we always see is they'll get bailed out by the Bank of China, but it's going to be damaging when it happens. So with China, we want to be very careful about where we invest. I really don't want to be into the banks, right? So I'm not going to use this spider fund. So for me, it comes down to do I want to use the MSCI fund, or is there something better? What is this green line? That is something called the Crane Shares China Internet ETF. And I gotta tell you, I'm pretty interested in this, especially on a big pullback. These are sort of like buying QQQ without Starbucks and Walgreens. This is essentially a technology ETF based in China. And this is where they're putting most of their focus of the government money and the government policy. I think that if we can buy this on the cheap, this is probably the ETF that we want. So we add our money flow, which we've talked about before. We want to see if money's coming in. No. So I want to show you something here. Look at that. Money flow started to fall, and the ETF started to fall. If you follow money flow, you're generally going to do pretty good. So while the money flow is still heading down, this is probably going to still keep heading down. Eventually, you'll get choppy, like right here. See that? And then it starts to go up. These choppy periods near the bottom indicate reversals. Look at that. Okay? So if we follow the money flow, it's very easy to do on Y charts or stockcharts.com. Stockcharts.com has some free stuff. Your brokerage probably has free stuff. Take a look at different money flow indicators and how they coincide with market advances and declines. So what I want is I want to see this get down to close to here, right? Negative 20, 25, 30. Almost there. See it jitterbug a little bit. Then that'll probably be a spot where we can buy it. Holdings, Tencent, which is one of my favorites. Alibaba, which I'm told should be one of my favorites. NetEase, Baidu, which is basically their Google. And don't think for a minute that our Google is going to go into China and I'll Google Baidu. JD.com, which we talked about this week. You go C-Trip, Go right down the list. If you Weibo, I've heard of. So just go through this list of companies. Even if you have to just read their Wikipedia page, most of these companies have investor pages in English. So take a look at these. This is a good group. As a group, it has kicked the crap out of everybody else for a few years. Why is that? Comes back to the slow growth forever economy. Comes back to the fact that the old grandpa stocks are probably not going to do that well, right? There is not a new wave of up and coming revenue out there anywhere in the world. China's demographics don't have it. Japan's demographics don't have it. Europe's demographics don't have it. Africa does, um, and India does in particular. Africa doesn't really have the structure that we want to invest in unless you're really a venture capitalist. India is a place that we've talked about we want to get into on their corrections as well. Brazil, somewhere to take a look at. Mexico, somewhere to take a look at. Canada, somewhat. Australia, somewhat. United States, somewhat. So if we're really looking for great long-term growth, India, Brazil, and Mexico probably are going to become a thing. India, Brazil, Mexico. MIB, BIM. Should we call those the BIM stocks? No, that's probably not good. But we want to keep an eye on these things. China, though, if China crashes, right? You see these double tops? Almost look at where those keep bouncing off of that range. If we get down into this range here for this fund, that's kind of a no-brainer to buy it. So keep that in mind. China. All right, let's move on to Tesla. I don't even think I have anything up on Tesla. But there is an article that I commented on. So probably Tesla buyout. Who knew what where? So I just want to talk about the shorts, the Tesla shorts, how Musk has totally crushed them again. A couple days ago, Musk tweeted out that he is thinking about taking the company private and that the funding is basically secured. Yeah, he just said funding secured. So if anything gets him in trouble, that would be it, because he better have, partners to do this. For Musk to take Tesla private, it's going to cost about $50 billion, maybe $60 billion. And that's if buys out every single share, which isn't going to be necessary. So in order to take a company like Tesla private, remember, Musk owns 20% of the company already. He's going to need to get firm commitments to take another, third of the company private. And then he can give everybody else the option of staying with it or just taking a cash payout. The odds of him not being able to secure the votes to take it private are pretty slim. He's going to be able to get the votes. The question is does he really have the funding? And my guess is that he does. Here's why. There are countries with sovereign wealth funds in the world that would love to see Tesla succeed. And they would love to have factories, gigafactories in their countries. And they know that the world is going towards electric vehicles eventually anyway. The only question about electric vehicles is how fast it takes for us to get there. I have talked about this on several occasions, including on television. What is the curve for oil? Well, this decline in the use of oil is going to be impacted by the replacement of internal combustion engine cars by electric vehicles and hybrid vehicles. When does that really start to happen? Well, I think the writing's on the wall. You have a mass production car at GM, which gets good ratings. Nobody buys it, but it's actually a pretty well-priced car, the Bolt. And I believe the Volt is the hybrid. So I've always thought plug-in hybrids made a lot of sense, but we'll see if we go straight to EVs. I don't think so. I still think the plug-in hybrids make a lot of sense because you get the extended range. On SUVs, that makes a ton of sense. The United States is an SUV country, and I think that the rest of the world eventually becomes at least the small SUVs, right? The RAV4. Just talked to a client this morning who bought a RAV4 hybrid. So it's all coming. It's just a matter of how fast. And the shorts throw out a lot of narratives that are complete and utter. Here you go. First swear word of the day, bullshit. And the shorts are colored by ideology, jealousy, and stupidity. And make that real clear. The shorts in Tesla have been wrong for years, and they're wrong now, and they're going to continue to be wrong. For them to whine and complain that Tesla isn't making money yet is just utter nonsense. It shows a complete lack of understanding of what happens when an industry transforms the world. If you go back to the railroads, to Ford, to the internet, right? The most recent one would be the internet. None of those companies made money for a decade or more. And now all of a sudden, who's the most profitable companies in the world? Google, Amazon, kind of Amazon. He spends all the money. Could be profitable. Facebook, Apple, right? All these technology companies that didn't make any money in the 90s and really didn't even make any money through the financial crisis. In the last 5, 6, 7, 8 years, they are profit machines, cash flow generating machines. Now, in the EV space, the thing is there's a lot of entrenched competition. So while we're going to see a huge shift to electric vehicles and hybrids, we don't really know who the winners are going to be. And we don't know how long that's going to take. That's why Musk is taking the company private, in my opinion. It's not that he doesn't really want to be a public company. It's that he knows that the time frame is uncertain. So when the shorts run around and say Musk is a liar because he missed the target, I've got a harsher swear word for them. It starts with F, ends with uck, you. These guys are so dumb, it blows my mind. Look, they're changing the world. BMW is helping them. Toyota's helping them. Volvo's helping them. All these companies are moving in that direction. He doesn't have the legacy expenses and the legacy debt that all these other companies have. So I want to just show you something. Let's take a look at Ford. And remember, for them to compete with Tesla and BMW even, and Volvo, Volkswagen, Toyota, they have to overcome how much debt? $92 billion. $152 billion to all the long-term liabilities. Okay, let's take a look at GM. 70 and 98 billion. Let's take a look at Tesla. 9 and 11 billion. Get the point? Tesla doesn't have the legacy problems that GM and Ford have. And GM and Ford still have to convert all their plants to be able to make EVs and make hybrids, while they still somehow can service their debt. Okay? It's not a big deal for Elon Musk to take the company private or just dilute the heck out of it. Now, the reason why he's not going to dilute the heck out of it, and I actually missed this, is that he has a bond that's convertible at $360 a share. I didn't realize that he had to keep the price above $360 a share. If I had really known that, I probably would have bought the stock back when it was under 300. And that's my mistake for missing that. But I think that he's going to take the company private. And I think that it's going to be done with a couple of sovereign wealth funds and a couple gigantic investors. I think it's probably over $420 a share. I think it's probably pushing $500 a share. So if you can get a sell-off in Tesla that's not related to him not being able to do that, right? You might want to get involved with that. When he takes it private, they're going to do a special investment vehicle, and it will allow accredited investors to stay invested. So if you're a non-accredited investor, meaning that you have under $1 million and under a $250,000 your income, you probably won't get to keep your shares. You'll have to take the cash. But if you are an accredited investor, if you're a millionaire or you've had a $250,000 income, I think it's 2 of the last 3 years, then you'd probably be able to stay in that fund. And here's the way it would play out. You'd only get a chance to sell your shares once or twice a year, maybe 3 or 4 times, but probably once or twice. During the first several years, while the company stays non-profitable, and because they'd strategically be able to do that and just keep reinvesting in growth, you're going to have the stomach for a share value that would be much lower privately than it was when it got taken private. And you're going to have to wait 3, 4, 5, 10 years to really make a lot of money on Tesla if it really becomes a great stock to own down the road. Here's the reasons why it probably won't be, right? It was not going to go out of business, but it's the competition, right? It's the slow growth forever plus the competition. BMW's EV and hybrid direction, the what the hell is it called? BMW EV. The I models. These cars, my buddy bought one. He worked for ABB in the power division, setting up superchargers. This is a pretty cool car. I was in it. It's a little car, but it's a pretty cool car. So, when you take a look at best EVs, just get something, top rated EVs from Edmunds. What you're going to see is there's a lot of competition. The Chevy Bolt is actually a pretty damn good car, but it's little, and Americans hate that. That doesn't mean they can't sell this in China if President Trump doesn't goof them up, right? Or in Europe, right? They don't have big parking spots, right? The Nissan Leaf, I got a buddy that owns one of these. I think it's a junky car. They have all the traditional Nissan electrical problems manifest in this car. Hyundai, I tell you what, I've seen these. I've been in these. Pretty cool. Kia Soul, I think it's an ugly car. I don't know why people like that, but, they do good commercials. So the Model S, I've been in a Model S, fantastic. But the point is that you've got this whole world of electric cars coming. And while I think probably the Model S is the coolest one, best one right now, if I could afford it, I guess I could afford it, but I just don't like spending this kind of money on a car. I could buy a condo on a beach in Costa Rica for this. It is an awesome car. I've been in it, right? This is interesting. They didn't even list the other ones. Well, there's other cars out there. My point is that they're coming. And the one thing that might really blow the EVs away, at least for a little while, is the hybrids from Toyota are awesome. So if you want to take a look at that whole space, take a look at Toyota. I think Toyota is the company that if I could buy them cheap, I'd buy them cheap. Because remember, Tesla shared a lot of technology with them years ago, and their hybrids are only about $1,000 more than their internal combustion engine vehicles. So if you're going out to buy a Camry, if you're typically a Camry buyer, why wouldn't you buy the hybrid? It's only $1,000 more, right? If you're a RAV4 person, why wouldn't you buy the hybrid? It's $1,500 more. Me, I love the 4Runner. I've got a 4Runner. I'm keeping it as long as I can because what do I want? I want a hybrid Forerunner, and it looks like in 2020 they might pull it off. So it'd be a 2021 model or 2022 model. So 2020, 2021, they had a concept car, and I think that's the direction they're going. So they have to incorporate the concept. I forget what they called it, but let's see here, Toyota. Yeah, this. They're going to incorporate this concept into the next generation of Forerunner, and boxier, tougher looking car, but it's likely to be a hybrid. So, I mean, look at that. I mean, it's going to be a pretty awesome vehicle. And apparently, the doors open two different ways. So, you know, what's coming in cars is pretty neat. Just the thing to remember as an investor is that there's a lot of competition. So you have to pick your spots. You have to find value. You have to understand that Tesla is going to exist. It's probably going to rally here on the take private, which I think is probably going to happen. And if you want to be in Tesla, go ahead. I'm just telling you, it probably won't be a great investment, but you'll be helping change the world at a certain level. So if that's important to you, if you want to put your money where your mouth is, have at it. But at the same time, you could buy BMW, you could buy Toyota. There's other companies that are going to help change the world. And I think the best thing you can do to help change the world, if you really, really want to help the climate, buy a hybrid. Buy an EV. There you go. That's how you do it. The capital structures aren't that, you don't matter to their capital structures that much, I guess, is my point. Not in the long term. Now that Tesla's probably going private, you don't matter to them anymore. And that's what they care about. Is he just wants to make sure that he can help change the world, because that's what he's in it for. And that's why Exxon and Chevron are in big trouble, because their legacy assets are not going to be able to handle this. And somewhere in here, the stock market's going to realize it. And Chevron and Exxon are going to get the crap kicked out of them. Now, you really want to take part in the whole divestment of fossil fuels. I will tell you, in a few years, I'm going to start shorting a lot of stuff in the fossil fuels. I'm going to start with coal. I will be shorting coal probably in the next 2 years. And I'll be shorting oil sometime in the 2020s. And I'm going to make a lot of money. And I'm okay with that, right? I'm betting on oil going up right now because of the engineered shortage of oil that's developing, because the deep water drillers got destroyed, and the fact that demand is still going up, at least temporarily. And Saudi Arabia has really solidified themselves as a swing producer, and they want higher oil prices. And by the way, President Trump decided, instead of waiting for the Ayatollah to die, let's put sanctions back on them. Now, we saw that China the other day decided not to put tariffs on American oil. Fuel, yes, but oil, no. I'm still holding out hope that we get a positive surprise on the whole trade stuff, trade wars. But as I told you a few weeks ago, I'm less confident. Because I'm less confident, I have some hedges. Because I believe the oil has really nowhere to go but up, I own oil. And I'll just show you this chart. So USO. Money flow. There's huge skepticism about oil. Why? Recency bias. Higher lows. See, this trend line, stop breaking down. You'll see this wedge that's developing. That's calling for a breakout. Now, theoretically, these breakouts can happen to the downside. I don't see any fundamental reason why that would happen. So that means the breakout's going to be the upside. I think that you can see oil really rally here hard on any Iran disturbance. And then again next summer. So it might rally, come back, and then rally again. So I've talked about for 2 years that I think oil probably gets, sniffs around $100 a barrel. I think that's imminent. Next 18 months, probably, maybe the next year. I think that we're going to see $80 oil on anything that bad that happens in the Middle East. And I would speculate, and I've been right about all of this. When I said that there was a war coming to Iran almost a year ago now, I've gotten the protests right. I've gotten the general trend in the price of oil right. The oil stocks have started to move up. They still haven't really had their breakout either. I think that if you put all the pieces together, the lower production from offshore drillers, or the less development from offshore drillers, less development from oil sands, crisis in Venezuela, sanctions on Iran, rising demand, Saudi Arabia able to control the swing production because we don't have enough pipes in the Permian until next year. The next year could be a huge year for oil. Huge year for oil. Everything seems to be getting in place. When you take a look at XOP, the oil stocks, these are stocks that are all starting to become very profitable. You got your rally, and now it's been chopping along. If you know anything about technical analysis, you like to see higher lows, right? You'd like to see wedges develop, right? Top line stays the same, bottom line starts moving towards it. These could break out huge. That's why I have calls on XOP. That's why I sell puts on XOP on down days for new clients. There's not a lot of risk here, right? There's just not a lot of risk. You're not going to see these stocks go all the way back down here again because you're not going to see the price of oil collapse. Now, does that mean that oil can't drop $5 or $10 a barrel? No, that's not what it means. But a collapse in the price of oil is when it goes from 130 to 35. Now, I scolded somebody about this today, talking about the bottom falling out of Occidental. What the hell are you talking about? Oops. OXY. What is going on here? What is the bottom falling out? Even from 78 to 64, is that the bottom falling out? No, you want to see the bottom fall out? Maybe from 100, right? That. From 100 to 60 over the course of a year. When people use extreme language, it colors your thought process. That's bad. When you listen to CNBC talk about a huge move in the Dow Jones today, it was down 0.76%. You should swear at them. It'll make you feel better. They're dumb, right? They're people who washed out of Wall Street and they look pretty on TV. It's nice that they have the ladies' legs hanging out like that, but reality speaks here. They're dumb. Most of them are dumb. They're rich and dumb, but they're dumb. So when you get these pullbacks, and that's all it is a pullback. It's not the bottom falling out of a stock. You want to see a stock that had its bottom fall out? A little company called General Electric. This is a process. So from 59 to here, and then the financial crisis got down to 6. Right? This is the bottom falling out. This is the bottom falling out. This is the bottom falling out. And cumulatively, anybody who didn't realize what was going on deserves what happened to them. This is not the bottom falling out in here. This is the beginning of a rebound. And these rebounds take years. So anybody who's trying to trade these on a daily basis, stop listening to me. If you're trying to swing trade, I'm actually pretty good at that. But I don't share most of my swing trades. I do those myself because I know that most people can't execute them. If you're not executing on them on your own most of the time, you probably shouldn't be doing it, right? If you can't already use technical or quantitative analysis, I use quantitative, you shouldn't be doing swing trades. You wait for an opportunity here or here or maybe in here to buy a longer term position. And you should own your stocks for 1, 2, 3, 4, 5 years. Position trades. Get through a whole cycle. Stop thinking about one day. Stop thinking about 1 week. Stop thinking about quarters. Musk, who is smarter than every one of us probably, and I mean that. He's clearly a top 1%er in brains. One of the reasons he's going private is because of all the short-term thinking. Stop thinking short-term. That's how the market thinks. If you want to beat the market, stop thinking like the market. Wait for the market to do stupid things, because it does, because it's made out of people, and 80% of investors are bad at it. And find these opportunities. Now, how far down will Occidental go? I'll tell you what, I think this is probably pretty close to it. If you want a good dividend-paying stock, buy Occidental. Oh, look, it popped already today. I bought 1,000 shares yesterday, so good for me. But they pay almost a 4% dividend, and somebody asked about this. Why did Occidental get bumped? Again, I'll just tell you, people are dumb. I hate to tell you that, but 4 out of 5 investors are bad at it. They probably have a hard time picking out a toothbrush too. So, when the market does something dumb, just recognize it. Don't think like the herd. Get away from that. Look at the company. Read their reports. What did they do? They sold a bunch of their midstream assets for $2.6 billion so they could spend more on production. Now, their expenses went up a little bit, but that was to be expected because they're trying to drill more, and the market got mad at them because their capex went up. You want their capex to go up. You know what that means? Occidental is betting on a rebound, if a further rebound in the price of oil, right? They sold their midstream assets. I mean, I'm surprised they sold the port, to be honest with you, but they sold midstream assets because they're overvalued. And they said, you know what? We're going to pull all that money forward rather than run this thing for 20 years and then have to worry about what happens at the end of oil. So they sold their midstream assets, and the smart companies are doing that. Conoco did it, right? I said the other day that Exxon and Chevron should sell their midstream assets. That might save them, at least part of them. Will they do it? I don't know. In fact, you know what? I will lay a bet that either Chevron or Exxon spins off or sells their midstream assets in the next few years. They're going to have to anyway. We'll just see if they get good dollar for them. Right now, I would think spinning off those assets would be the way to go. But, maybe there's a buyer, but they have an awful lot. They're big assets. I don't know if there's a buyer. So they probably have to spin them off. Maybe Chevron and Exxon put their midstream assets together and create a new company called, I don't know, Shex or Exov. I don't know, whatever. But, that might save them. So Occidental had $2.6 billion dropped to the bottom line. They're going to use most of it for drilling, mainly in the Permian. And one thing to keep in mind, I showed a chart last week, so go back and look at the last video, because I'm not going to be able to find it quick. By 2020, there's going to be more pipes in the Permian that maybe we even need. So they know that. They know there's a shortage on pipes today, so they sell them, knowing that tomorrow there's not going to be a shortage in pipes. They probably got top dollar. And now they can, and I'm sure they have agreements so they can use the pipes like a lease back, and they get to go drill more oil at higher prices for the next several years. The smart oil companies are trying to get the oil out of the ground as fast as they can because they know that chart that I showed a little while ago, they know this is coming. They know it's coming. Why else would a company sell their pipelines if they thought this was going to go forever? They know that it's not. All right. Take a couple questions. I'm going to try to not have this take an hour and 20 today. Yeah, you could probably raise your put price on XLV a little bit, or you can take the cheaper. I think that 85 was a good level, or that 95, whatever it was. That level I had was a pretty good technical level, 85. So if you wanted to raise this to a higher number, you could take a look at the implied volatilities in the prices. You'll figure it out. Yeah, it was a great trade. I'm not quite ready to sell puts on VXX because it just rallied a little bit. But yeah, I would like to. Can we move along? Oh, kiss my ass. All right. BMI stocks. That's not the oil chart. I don't know what I'm talking about. I had a wrong chart up there. Well, too late. So there's not a lot of questions up here. Oh, somebody asked about, yeah. So we talked about China. Yeah, all right. Here's your last chance to get a question in. Copper price is going to go lower in the short term. Selling puts on TUR. It's TUR. Turkey? No, not yet. Man, wait. Who says they can't set a new all-time low? Turkey, here's a good chart. What's the Brazil? EWZ, there we go. What happened to Brazil? You know, take your time on these. And ask yourself the question with Turkey, with President Trump being our president right now, what are the odds that he cuts a deal with them? What are the odds that they work something out? He's pushing everybody that he wants to push. And I'm not saying it's a bad thing. Erdogan is a jerk. Xi is a jerk. The Ayatollah is a jerk. About the only thing I like about President Trump is that he's being a jerk to the jerks. I love that. Now, the problem, of course, is to cause a war. But if they manage these correctly, they just do everything through economic channels. With China, because they're so big, you just have to cut marginal deals. Iran, you can let them fall right into civil war. What do we care? Right? It'll end up being better for them. We will have to help wipe out their military so that the regular people don't get killed. And that's just the way that works. I mean, I'm not saying it should work that way. I mean, I'd love for us all to sing Kumbaya and get along. But you're probably going to see the United States attack the IRGC in the next 3 months. Or how's that for prediction? I think between September 11th and November, we attack Iranian Republican Guard Corps somewhere in Syria or Iraq. And we might even bomb their missile factory. We might drop a mother of all bombs on their missile factory. I don't know where that missile factory is, though. If it's in a city, that makes it awfully difficult, right? So you really don't want to cause any damage or kill anybody inside of Iran that isn't innocent. You really have to make a point of avoiding that. If we kill Iranian civilians, that undoes all the positive pressure we're putting on the Ayatollah. We need to attack their military outside of the country, and hopefully that's enough to get the military to stand down within the country and take the side of the people and act like Egypt versus taking the side of the Ayatollah. We will see. Yeah, I still think natural gas has to break out at some point. So I'm being very patient with Antero. I think right now is a good spot to sell puts. I don't, there's other healthcare REITs or healthcare REITs out there. I don't want to own them. Most of the REITs are overvalued, and think about what it's going to cost them when they have to redo loans. I'm not, there's people out there saying that the REITs are a great value right now. I think they reflect the problems that are coming. So I'd be careful with REITs. All these guys on Seeking Alpha who are touting REITs as like the greatest investment in the world, they're going to get a lot of people hurt. It's got to buy this growing 12% dividend paying REIT. Yeah, until interest rates go up, until half of their leases go under. You just don't want to get into REITs ahead of the next recession. And the next recession is the next few years. The Fed's tightening. That's what'll happen. It happens every time. It's not like I'm speculating on that. It happens every time. You don't want to be in a lot of REITs. Thoughts on the MU? Man, I have some orders in to sell puts and to buy calls. See these? It's one I'm trying to get. Trying to sell more puts on SunPower too. Right now I have some puts I bought on the SPY, basically about even, and I'm trying to make a 50% gain on it, although I can adjust that up or down. My shorter dated calls that are out there, I have sell prices on, just because the clock is running on those. So there you go on that. I don't even think the appeal is going to get held on Time Warner and or on Warner and AT&T, right? So let me pull up a better one. So AT&T 2.43%. I'm basically even on that, maybe down $1. CenturyLink though, bigger holding. We're still really starting to see that one. Like I told everybody, this dividend on CenturyLink, it's not going to come down because they cut it. It's going to come down because the share price goes up. So when CenturyLink's in the 30s again, in the next couple of years, next 2, 3, 4 years, and it might happen quickly. They're just gonna keep growing their dividend. It just the yield would be more like AT&T's. Where'd AT&T go? Be more like AT&T's. I traded out of Verizon. I'll try trade back into it. Made like $3 or $4 on it pretty quick. Yeah, I make 10% on something in a week. You're like, I want the cash. Calix, they're not doing anything just yet. That might be for another quarter. So next quarter, hopefully. And Kana, I don't own a lot of shares, but I own calls. A lot of XOP. Still own oil. I took about a third of this off. When it was in close to 77, whatever it was, I sold a third of this position. So my cost basis is actually lower. But you can see today, oil is up, and the stock market, right there, Oil is up, the stock market is down. Get used to that. Find your spots to buy technology. Somebody asked me about this earlier in the call privately. Quarter Hill is a speculative position of mine that somebody else tipped me off to. I'm going to talk about it this weekend. But it's super high risk. But interestingly, it's a super small company that pays a dividend. And they look like they won a lawsuit and may or may not go to appeal. They might just have a bunch of money dropped at the bottom line. So this could be a stock that doubles or triples pretty quick. They're basically in the technology space, and they're buying and selling corporations that they think need to be consolidated. So you see my other calls here. Chesapeake, I really think this stock is going to 8 or 9. So I want to hold on for the home run. I know people are tempted to trade these on every movement every week. Don't do it. Don't do it. Look for ways to buy at the bottom of those big corrections and hold off. It's always better to wait a little too long, right? Because if you miss something, you just get the next opportunity. If you get in too early, you're too early. Sierra Wireless got put to us. Everybody's like, "Oh my God, Sierra Wireless got put to us." My average cost basis is $19.06 minus a little over $2 in premium. Actually, $2.50 I got on one of them and $1.56 on the other. So my cost basis on this is in the 16 something range. Sierra Wireless is going to keep going up. SunPower hasn't happened for us yet. If you don't own SunPower yet, sell puts or buy the stock. It's not going to bounce around down here too much longer. I really want to show you SunPower. Read their website and Total's website. Don't read blogs where the people don't know any of the technical information or any of the financials. They just look at something on a balance sheet and they go, bad, bad, bad. This is another stock that's showing really good consolidation. Starting to consolidate. When this, had the little death cross here, when this bottoms out, right? When this gets a little bit lower, you're going to get a turn. So could it get down into the 675 range? Absolutely. 650? Yeah. Seems like it's triple bottomed. Could it do it again? It could. I don't think it will, but it could. And I'm trying to sell puts. I'm really trying to finesse the puts. So, this is a stock that you're going to see this again. You're going to see this happen again. When? I don't know. A lot of times these big jumps are separated by 10, 15, 20 years. And you can go back to company after company after company, and you see patterns like this. It's the reinvention of the company. It's the evolution of an industry. It happens. What are the best 5G stocks? Well, we've got like 5 of them, right? We've got CenturyLink, we've got AT&T, we've been in and out of Verizon. I haven't told anybody to sell Verizon. I just swing traded on my own. Calix, Sierra Wireless. Right down the list. We've got a whole list of them. If you like, why not play Soxel? I'm actually in the other one, right? I'm in XSD. I'm not a big fan of these, right? These reset every day. You really wanted to be down 7% today? Man, unless you are an extraordinary trader, and most of us aren't, especially dailies. If you want to be in semiconductors, and I am, I like XSD, and I've told you why before. Why? Well, because they have SunPower and First Solar. They have exposure to solar, right? I like this fund better than the other ones because they have exposure to solar. Cypress has some exposure there too. I just like the makeup of this index. So when I look at these indexes, which ETFs to use, I look at these ETFs and I screen this out for the top holdings, and I try to figure out, okay, using Morningstar. Morningstar has a good tool for this. What's the average weighting of this stock, right? So with Morningstar, and then we're going to finish after this. With Morningstar, I can get a rating. An average rating of the stocks in there, right? So they're telling me portfolio. Right? They're giving me the ratings on all these. Oops, I don't want to do that. But portfolio weight. They have the star ratings on here somewhere. There's a shortcut for I have to find it. I haven't looked at it in a while. But you can get all these reports. And you take a look at these, you say, okay, if a whole bunch of these are undervalued, then that means that we probably have a good chance for this to rally, right? Because when you buy growth at a value price, you generally do pretty well. So, all right, CDE. What do you know about CDE? You just know that there's some gold there? What do you know about it? What's their new plant? Their new mine. The new mine they have is a big deal. So take a look at, there's a reason why this is getting beat up, because it's getting beat up with the metals. I think this is probably a pretty good spot, right? It's not going to be quick growth, but if you want something that is optimistic about the world, about the needs for these metals, right? Take a look. Lead, take a look at this. Learn about the company. I buy options on the 3-time leveraged ETFs. Oh my God. FC Norris, are you Chuck Norris? Is Chuck Norris a subscriber to my service? Because that is the riskiest thing you can do in the whole world. Good luck. All right, time to go. Trevally Mining. I don't know anything about them. All right. Have a great weekend. Another hour and 20 minutes. One of these days we'll have a 1-hour call. But I have a great weekend. I was a little subdued today. I've just been totally busy with work, and I'm almost caught up. Next week, I will be coming at you from St. Louis, Missouri. Actually, a suburb of St. Louis, Missouri, as I watch the Milwaukee Brewers play the St. Louis Cardinals at Busch Stadium. My first time there. I went to the old Busch. Now I'm going to be to the new Busch. And then it's off to Connecticut for World Series of Poker, New Hampshire mountains to camp, New York City for a couple days, staying in Brooklyn. So I'm going to get to hang out in some of the old Brooklyn neighborhoods, just 2 days. Rented a yoga studio. Guy had 2 bedrooms in his yoga studio, and he's moved to a different yoga studio, so he Airbnbs this one out, so we got a pretty big place for cheap. Manhattan was crazy expensive on this run, but Brooklyn was pretty fair. Then off to Washington, D.C., via Philadelphia, where I'll meet a couple clients and have a cheesesteak. And then in D.C., we have a place that has a rooftop club, not a rooftop club, a pool and a workout facility with a view, right next to Chinatown, between Chinatown and the Capitol. So should be a good trip. Head back through Pittsburgh. If anybody's in Pittsburgh, love your city. Happy to see you. That will be September 1st. I'll be in Pittsburgh. But I'll put up my itinerary on here, and if anybody wants to meet up, if we happen to be crossing paths, you can get to me. I'll be around. Have a great time this weekend. Bye.